All right. Making moves, real estate community. It's Tuesday at 10. So, your favorite host, Tim and Tim, we're back again for another episode of what is going on in this volatile market or shifting market. Everything seems to be changing day by day, minute by minute. The 10-year treasury bond is over 3% right now, which is crazy. So, if those of you that don't know, the 10-year treasury bond is what the mortgage loan rates follow in terms of interest rates. So it's really, really important to stay up with that kind of stuff in order to understand where interest rates are trending because they kind of follow each other on a one-to-one ratio. Tim, it looks like you're having an issue. I can't seem to. It looks like the broadcast was deleted. Try to create a new one. Well, I guess we're not streaming in the Facebook group today. So, anyways, how you doing today, man?
What's going on, man? I just trying to get through all these changes that are going on. I'm not, by the way, I'm not seeing that same thing you saw, but who knows with the Facebook group.
Technical difficulties.
Yeah, I think there's gremlins going on in the world today. I've had to restart my. Thank you, Michael. I think I've had to restart my my home internet like 3 times already.
My docking station was causing me some issues earlier today too. So everything's just having technical difficulties.
Fun times. Yeah. Oh, hey, here we go. All right, whatever.
Yeah.
Okay.
Well, all right. Before we get into the meat and potatoes of today, Tim and I have been working very, very, very diligently on some things on the back end that we're really excited to launch. What do you think, Tim? Next week? You're setting the goal for next week?
I hope so. It all depends on lending.
Oh.
There's a segue for you.
Well, all right. So since you kind of precluded to that, what is going on? So for those of you that don't know, Tim Vest and I, we do like most of all of our deals together. Tim Vest has the wonderful pleasure of dealing with the banks. We found that Tim is very good at negotiating with the banks. He understands the terminology because he worked at a bank. He's just very, very confident and comfortable with the whole lending space. So Tim Vest has been heading up our lending side of things for our acquisitions lately. So Tim, I want you to talk a little bit about what are you seeing? What are the banks coming back to you with? How are the banks handling new loans? What kind of things are they doing in order to mitigate their risk? And how does that affect us?
Yeah. So folks, this is just my experience. So you guys may be seeing something else, although I'm hearing it from other folks as well. So the biggest thing I'm seeing right now is obviously rates, right? I mean, I don't think that's a surprise to anybody.
Rates went up?
Yeah, rates are going up. Rates are going up. And what's funny is, everybody's like, rates are going up, rates are going up. Well, if you actually look last week, rates actually dropped a little bit. So it's not this clear linear progression up. They go up a little bit, they settle down. They go up a little bit, they settle down. So the idea that they are tied directly to any kind of 10-year or base rate or anything like that directly isn't quite true. They're based on it, but it's not a direct tie. Just because they go up based on the Fed's raising something doesn't mean they stay at that new rate all the time. But the trend is, guys, the trends are going to be up for a while. I mean, the Feds keep talking about raising. They're probably going to raise here in another week or two. I forgot when the next meeting is.
I think it's June 15th they're talking about is the next meeting around next week.
Yes. So what's that doing? So a couple of things are going on in the market, right? Like people are worried about recession. People are worried about rates. People are worried about affordability. A lot of things, a lot of panic out there, right? So what we're seeing more from lenders right now is obviously the rates, but then the next thing we're seeing is their risk profile is changing drastically. So those tertiary markets that you were getting into for at one point, and you could just go get 20% with 24 months interest only at 4.5%. Well, for the time being, that's gone. That is don't count on that. If you're not underwriting to 5.5%, 6% in those kind of markets, and if you're looking for a bridge product 7+ as far as an interest rate, you're probably being too aggressive and not realistic. The other thing too is 25% in a market like that probably gone. 30%, 35% is probably where you're going to land, especially on a bridge product.
Hmm.
So if you need a bridge to get you to stabilization, it's going to cost you more. It's going to cost more capital. You're going to have to put more money down, things like that. So those are the things that we're seeing. The most frustrating thing for me that I'm seeing. Blah, 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 blah. Yeah. Yep. Very good point, Richard. Um, the most frustrating thing for me that I'm seeing is the amount of documentation we're having to produce. And the reason hey, believe me, I was doing this stuff back in 2006, and I saw no doc stuff going and going and going until 2008, when all the no docs and the crazy lending practices really screwed the pooch. And what I will say is, the documentation doesn't bug me so much. In fact, it makes me very confident that we're not in a situation like we were back then, because we're not. So, don't listen to anybody telling you that. What I would say is that just be prepared to produce documentation and produce it quickly, because if you don't produce it quickly, the lender's waiting on you. And what did we just talk about with rates? They're changing quickly. They go up, they go down, they mostly go up. If you don't get your documentation to the lender, they can't get that commitment letter to you, they can't lock you in, and your rates are going to go up. Delays are going to cost you money right now. So be quick, be ready to go. And I would say be proactive, don't be reactive. Have your documentation ready. Now, you can only do that to a certain extent, because I will tell you, and Tim will tell you, like, even last night, I got a request. I thought we were done on a loan. I thought we were done. Lender came back, asked for 2 more pieces of documentation that we had to produce. I've never been asked for this before. We had to produce two more pieces of documentation, and we turned it around real quick. We had it to them last night, actually, before the end of the night. So they had it first thing this morning. But these things are kind of frustrating. They can cause delays, and right now, guys, delays are costing you money.
Yeah.
So those are
So
the
yeah,
things that we're seeing.
in terms of documentation, I want to talk about real quick something that you and I had a conversation on, was that the mindset of the banks has changed. The mindset of the bank now is they're trying to find a reason why not to do something. So that's why they're continually asking for more and more and more and more documentation. And to kind of reiterate Tim Vest's point, is you got to know your stuff. You got to know your underwriting. You got to have everything that you need at your fingertips. You got to be organized, and you have to get the information to them quickly. Because if you're sitting there, sitting with sitting on your hands and not taking priority, not making it a priority, they're moving on to other things, and then the rates are going to go up, and it's a bad time for everybody. So it kind of goes back to the whole point that everyone preaches about, is be organized and be somebody that people want to work with and that people like to work with. So you can become somebody that people like to work with and want to work with by having those characteristic traits and being organized in your business, so that you have everything and you're ready to rock and roll, and they can see your professionalism in what you do. You're not just doing this as a hobby on the side. That's it's also another thing why we preach investing as a limited partner with people that do this professionally as a full-time job is a really great thing, because those are what we focus on. We focus on those systems, we focus on those processes, we focus on the relationships that are necessary in order to have good negotiations with banks. All of those things are very important, and they're very difficult to do if you have a full-time job. But I'm not saying that they're impossible. I'm just saying it takes more work on your end in order to make sure you're mitigating those risks, and always thinking about what is the next question the bank could ask, right? You're preemptively trying to be proactive about mitigating your downside risk in terms of what the bank could come back and do. So don't just put all your eggs in one basket as well. You want to be talking to multiple banks at one time, because everyone's appetite is constantly changing right now. Tim, how many banks did you reach out to on this last deal that we're talking about right now?
Oh man. So 3 local banks in that market, 3 separate brokers, and 2 national banks that I already had relationships with. So The number, I could look at the sheet. One of the brokers actually sent me a sheet of all the banks they put this in front of. So, I mean, you're probably looking 15, 16 total banks that took a look at this. And we're down to, we narrowed it down to the best option, and we have like two backups on the table. So
Right.
it's not that we're not getting lending. We are getting lending.
Yeah.
It's just taking a lot more time and a lot more effort to get it.
Mhm.
So by the way, guys, 30-day closes, don't sign up for that right now.
Don't even,
Unless you
don't even sign up for a 60-day close.
Yeah, unless you've got unless you got a line of credit to fall back on or something like that, don't go for, or you're doing cash, don't do 30-day close, in my opinion. Tim's right, like 60-day close, that could be troublesome as well. At least if you do a 60-day, at least have an option to purchase an extension in there of another 30 days or so. In there, and by in there, I mean your PSA if you're not familiar with that.
Mhm.
And then, Michael, good question. What kind of additional documentation are they looking for? It wasn't borrower specific, it's property specific. And even more specifically, it tends to be more about market and business plan. They're not as concerned with the property itself as they are with the market, what your business strategy is with the particular asset. And the particular one that Tim and I are talking about here, and without giving too much away, it sits close to a school, a university. It sits close to a university. Now, this is not student housing. We don't have a student housing business plan. And this particular one, and this goes back to what Richard said a few minutes ago about open market or holding it. This particular business plan does not go after students, but the lenders were very, very worried about us stocking this thing full of students, whether we were marketing to them or not, because that was going to make it very hard for them on the sell or the exit on their side to move that loan over to somebody else, to like a Fannie or a Freddie or something like that. It was going to make it very difficult if they turned around and all of a sudden we had like a 50 or 60% student population in this property.
Yeah.
So that was part of what they were looking for. The other thing that they've been looking for specifically is they want to see proof that the rents that we're hitting are achievable. And honestly, guys, I think what that speaks to, in my opinion, and part of this is because I've been asking the brokers and the lenders, like, why are you asking this? Like, these aren't aggressive rent bumps in our business plan, by the way. They're very conservative in my opinion. But I think the lenders are starting to get wary of these 15 and 20% rent bumps that they've been seeing all over the market. They're starting to ask themselves, when's it stop? Right? Like when's it going to stop? When are we going to get back to 3 and 4%?
Yeah, and full disclaimer, Tim Vest had sent out like a post or something about being wrong. Go back and read that post. That's because there were like 10, 15% rent bumps over the last 2 to 3 years. We have never, ever underwritten. I wouldn't allow it. I would never underwrite more than a 3, 4, 5% year-over-year rent increase.
Yeah. Hey, Tim, you're breaking. I think you're not doing that thing again, man. If you want to reboot it, I'll answer a couple of these questions real quick. Let's see. Do you guys anticipate a lot of 1031 exchanges? I mean, I'm sure there will be. I'm personally not seeing a ton of them, just because, quite honestly, Felipe, I don't go after a lot of 1031s, because in syndications they can be costly, and difficult to handle. I have seen a few out there. The biggest issue that I've seen with 1031s with a lot of guys is trying to figure out where to put their money. I have talked to a couple of folks that have that going on right now, and they're really struggling. Sorry, I'm struggling at Tim's camera angles. They're really struggling with, hey, I got this 1031. Where do I go buy? That kind of thing. In fact, I can give you one scenario where a guy I know and I are looking at something in another market in the Carolinas, and we've had a verbal accepted offer on this thing for, God, man, like almost 2 months. 2 months maybe. Like the seller keeps saying, I'm ready to go, I'm ready to sign, I'm ready to sign. I just got to find a place to put my money. And it's 1031. He can't find anywhere to put it that he likes. So he won't sign the document, which is a little frustrating from our side. But yeah, I know there's a lot of 1031 stuff coming down the pipe to a close, all that good stuff. I just haven't seen it, but again, partially because I don't really go after it. Um, let's see. Michael, did the appraiser not concur with our rent projections? So back to that, the property Tim and I are talking about. Um, it wasn't so much that they didn't concur with our rent projections. They they don't honestly, like, they don't know this market. Like when we started this off talking about like tertiary markets, this is a market that is um, it's outside of a really, really strong market in the South. It's just outside, about 20 miles. Um, they, as a national lender, and this is where uh, local lenders kind of can come in stronger than national lenders. Although on this case, the local lenders weren't able to. Uh, but national lenders, they struggle sometimes to understand some of these smaller markets, these tertiary markets, even though this one is, again, just outside of another one, a much stronger market. It's not that they didn't concur with our rent projections. It was more that they just didn't know how to verify that what we were showing was accurate. Even though in this particular case, we're able to take them straight to the current rent roll and show them that as soon as we have units available, the rents that we're projecting, we're getting, like, immediately. Units aren't staying vacant. We're not, there's not big concessions going on. In fact, I don't think there's any concessions going on, right, Tim?
Mm-mm.
No concessions, no delinquency, none of that stuff. In fact, we can show from January of this year through today a steady increase in both revenue and NOI. And we can show that as soon as units come online or come available to rent, they're renting within days, at the rents that we're showing. Um, so there's a lot of proof there. It's just the lenders are just kind of struggling with these outer markets, if you will. I have no doubt that if you put this exact same property, and this is going to be a black or white comparison here. It's going to be way on the other end of the spectrum. But if you threw this property in Raleigh, North Carolina, and had the same business plan, um, I'd have 15 lenders raising their hand trying to give me money for it.
Mhm.
It's just that their risk profile is changing, and over the last few years, when we were all running around chasing cash flow and yield, um, and we were finding in some of these secondary and tertiary markets and stuff, um, you know, nobody questioned it. It's just things are changing in the market now, and the lenders, nobody has a crystal ball, so the lenders don't know when it's going to stop, right? So they're like, we got to be careful, because you got to remember, when you're going to ask them for money, you're probably not going to ask them for money for like 3 months. You're going to ask them the money for 12 months, 18 months, 24, 36, 30 years. I don't know. And they are very cognizant of the fact that we don't know what's going to happen for sure over the next 12 to 18 months.
Yeah, I want to pedal back a little bit because I was having some issues there. To Mike Nasella's question, and they most of the time when a lender comes back to you with documentation requests or information requests, it's always going to be about the property because commercial loans are done on a debt service coverage ratio basis, right? So what the bank is doing is verifying that their bank note is going to be paid. And those of you, I hope most of you know, the DSCR minimum is about 1.25. If you're doing it on a stabilized basis, they'll look at all that kind of stuff. So that's why they really were digging into the pro forma on the property itself, not really as us as borrowers, because we qualify as borrowers, no problem. You meet the net worth, liquidity, and experience checkbox. Okay, no big deal. That only makes up like 20, maybe 10 to 20% of the loan is do you qualify. The other 80% of it is backed by the property. It's also a non-recourse loan, so they are digging into it even more heavily to make sure that, hey, if these guys screw up and we got to take this property back and take it over, are we going to be able to protect ourselves and not lose money? Because what's that? Warren Buffett's rule number one: never lose money. I wanted to kind of pedal back and talk about that real quick because I think it is so important. In that the difference between commercial and residential loans, less than 5 units, it's all going to be about the borrower, right? Debt to income ratio, W-2 income, et cetera, and so forth. Full disclosure, I can't even buy a house right now because I don't have W-2 income and I can't show income on paper, yet I can go sign on a multi-million-dollar loan, right? And it's like, it doesn't really make sense, but that's why we got into commercial real estate to begin with, because it makes sense to me with financials and numbers and all that kind of stuff. So
Yeah.
wanted to, touch on that real quick too.
Yeah, and hey, Michael, real quick, I think I didn't quite catch that first part of your question there when I was talking a minute ago. So I'm not sure if you mean the actual appraisal. So at this point on this property, we haven't even reached the appraisal standpoint, the
Yeah,
official appraisal.
it's just with the back end office of the bank, their keyboard warriors making sure that the
Yeah,
the pencils.
this is going through the like Tim's talking about there. This is going through their initial underwriting process, the lender's underwriting process, which is literally just guys sitting in a back office somewhere, doing market research on a computer. Nobody from the bank or representing the bank has physically stepped foot on this property yet. That won't in case you guys aren't familiar with some of the like syndications and stuff, and even some residential, the appraisal process doesn't happen until much later,
Mhm,
which by the way can be a big surprise. When
mhm.
and it's a surprise that's a little can be frustrating when it comes in, 2 days before close and it's not where you thought it should be.
And that's
Um,
where those extensions come into play because if you need to, you want to go back and fight the appraisal. Because remember, the appraiser, they're not trying to get you the highest valuation. They're trying to get you a safe valuation. So if they can get you at 80 or 90% of what the true value is that you're calculating, you have to go back and prove to them that they're wrong. And it has to be undeniable information. Like you cannot say that this doesn't increase the value of the property based on the information I'm providing to you. So, when we do get this term sheet, God, I pray it's today. It was supposed to be like last Friday. We got to order the appraisal like right away because they're taking like 6 weeks,
yeah,
at a minimum right now. So, that goes to show just trying to get your 30 to 60-day close is not going to happen if the bank is taking 2 to 3 weeks just to underwrite the property. And
yeah,
then you have 6 weeks on top of that for the appraisal and third-party reports and things like that. So,
yeah.
all stuff that you need to be aware of in this volatile market is giving yourself enough time and having enough options to fall back on different types of loan products through different banks and different companies and all that kind of stuff. So all we're trying to do here is portray what we're actually going through on a day-to-day basis right now so that you are aware of what's going on with people that are doing deals actively on a day-to-day basis to protect yourselves, to make sure that you're giving yourself enough time if you're going through an acquisition or you're negotiating a contract right now.
Yeah. So, Prasad, great question. And short answer to your question is yes. We are doing some bridge floating. I'm not a huge fan of bridge right now. All except in specific situations, and the property that Tim and I are talking about is one of those situations. Um, and there's a real specific reason for that, and part of that is that we're going through a lease up period. Units are coming online, they're leasing. Units are coming online, they're leasing. So like I mentioned earlier, we can see a clear increase in revenue month over month over month, right? So in that situation, the bridge doesn't bug me as much, especially if I have time. And I'll go back and talk about that in 1 second. But what I wanted to talk about was right now is the bips on the rate cap. I'm not buying a rate cap. It's expensive, quite honestly. And on a property like this, um, I'm just factoring in because on these, it's like SOFR plus 5.15, which right now I think would be like a 5.9% interest rate or something like that. I don't haven't looked this morning. Um, but so we're underwriting basically each month. So I'm assuming that each month it's going to adjust because they do look at it on a monthly basis, and it will adjust upwards is what we're assuming, that it's going to continue to adjust upwards. So every month, the rate's going to change upwards. Our loan payment's going to increase every month, but that works okay on this property because every month we're bringing another 8 to 12 units on, and that's 8 to 12 units more worth of revenue. So it's a product that actually works okay with this asset. What I don't like about bridge, and what I'm okay with as long as you can negotiate it in, is I don't want bridges that tie me into like a 12-month window or even an 18-month window. I want 3 years on a bridge product. I want 3 years to let rates settle and for me to kind of start to look for that window of time when I want to refinance out of the bridge. I don't want to be forced 12 months from now to go have to find something else, because I'm not convinced that rates will settle over the next 12 months. I hope they do. And I think they will settle over the next 18 to 24. But, I want a little extra time because, guys, one of the things that 2008 and 2009 taught me was time's your friend. I got backed into a corner on some things back in 2008, and I had no option at all. I couldn't wait it out. If I had waited out, if I could have waited it out, I'd be in a much different financial situation today. Um, but I just didn't have time. So that's one of the big lessons learned that I'm using right now is like, I need time. I need time. So I'm going back and I'm even saying, hey, I'll take a slightly higher interest rate if you'll give me another year. I'll pay the rate because I know what I can pay today, and I know what I can pay tomorrow. But what I can't do is what I don't know for sure is that I'm going to be able to refinance into something I like or that works, in 12 to 18 months.
And then also, if you think about it from an apartment investing standpoint, the rental rates, like what you're getting per unit, is going up. And if you give yourself more time, you allow those 12-month leases to renew, and you can renew them at market rate. And essentially, if you think about kind of ratios and things like that, as the rent that you're collecting goes up, it's mitigating the increase of the interest rates as well. So you can hope that if rents still continue to go the way that they have been, and rates start to stabilize out over the next 24 months or so, that it'll allow more time for the income to be able to produce enough income to cover the new debt service. Does that make sense? It's a time game, right? You're waiting for rents to pick up the lag because the rates are rising way too fast, like unstably fast. And what you're truly waiting for as an operator is you're waiting for the rents to catch up with the increased rent rates. And because it's jumping up so much, you need a little bit more time for the rents to kind of stabilize. You locked in your tenants on a 12-month. God dang it! What the hell?
Yeah. So
you talk.
yeah, I'll do it. So why am I not a fan of bridge loans right now? Just because they tend to be temporary. Now I do have a couple of. They're not traditional bridge products. I do have a couple of they're more like construction products that give me like an interest only with a draw period that then convert to a stabilized product without me having to refi. What I don't like are bridge products that force me into a refi event in a certain period of time. And that's why I'm not a fan of them right now, because there's a lot of uncertainty over what the future looks like, quite frankly. Like, let's not even put a time horizon on it. There's some uncertainty in what the future looks like. And with that uncertainty, again, just like I mentioned a few minutes ago, I like time. I want time because time buys me options, allows me to adjust, allows me to sit back and look for a window where I want to execute my plan. Again, it's not that I don't like bridge products as a whole. I just don't like bridge products that force me into something. And then too, like if you think about it over the last year, if I could have not done a bridge product on certain properties, I'll just be honest, I'd be in a better position right now than I'm currently in. I'm not in a bad position like Tim and I have a property down near Charleston, South Carolina, that is on a bridge product that we're going to have to refi sometime in the next, 14, 15 months. I'm okay with that one, because the rents are like ridiculously much higher than where we purchased it. But then two, I would be in a better position had I been able to go with a stabilized loan product on that. I mean, you think about where stabilized rates were just, 6 months ago. Like I could have probably put a 30-year on that thing or even a 25-year on that thing at like what, 4%? And
Yeah.
know I'm paying 4%, and my rents went from 1,000 and something up to we're getting new leases at 1,500 plus right now. If I
Mhm.
was paying the same 4% and getting a $450 rent bump, I
Crush.
mean, I'd be crushing it, cash flowing like a king right now. Which this is cash flowing well, but I know also that because of the product that it's on, which is a bridge product, I'm going to have to refi it here in the next 14 months, and I don't know what kind of rate I'm going to get. I can almost bet you I'm not getting 4%.
Oh,
Um,
absolutely. Yeah, you're definitely 4%. And then
yeah,
another thing, when is my mic better now?
yeah,
I switched over to my MacBook instead of the external one. But one thing you need to make sure of for you people that are the underwriter in your group is when you're hitting those refinances, you have to check your debt service coverage ratio at the refinance. And you might not be able to get a 75% loan to value. You might end up being at 70 or 65% loan to value and the increased rate. Because remember, the bank is still going to make sure that your debt service coverage ratio or DSCR is met. So the only lever that you have to pull in order to meet the DSCR to get out of your bridge loan is the loan to value, how much leverage you're able to get on that product. So um, please be sure to double check those numbers and make sure that you're not over promising to your investors. Now, I mean, all of the properties that we've owned, I've gone back and underwritten all of them with the rents that we're currently getting, built out another 12, 24, 5-year projection. And then I also been playing with the refinance loan to values and interest rates and things like that, because all of that's really important. And you can get caught with your pants down if you're not paying attention to it. So please be sure to check those things.
yeah. And Tim just made a really, really good point. And I think you guys have heard us say that before. Is like, hey, remember that underwriting, that's a living, breathing document. Always be looking at it. If not monthly, at least every 2 to 3 months. Be checking it, I guess, where you are and what the market's doing. Because like Tim said,
Volatility.
yeah, because like Tim said, he's going in and he's adjusting what we think we might get at the refi event, so that we're just aware. You just got to be aware, right?
Hmm.
As long as you know what's going on, you can adjust.
Hmm.
So
Absolutely. Oh, what did Prasad say here? Said, with many deals trading at around a 4 cap, what are some things we can include in our underwriting to make sure we perform as expected in case we end up doing the bridge? Where are you buying deals at? I mean, you have to be in Raleigh, in Charlotte, in Atlanta, in Austin, in Tampa. I mean, those markets are sub 4 caps right now, and truthfully, they're not cash flow plays at all. I mean, if your debt service is 6% interest and you're trading at a 4 cap, you're losing 2%, right? You're not cash flowing at all. It's pure equity gain. Um, I don't know if I really understand the question. Or what are things that we can include in underwriting to make sure we perform as expected? I mean, just really need to know what your income and expenses are going to be, right? You have to accurately predict what the value of that property is going to be and what your loan to value is also going to be at your refinance after your bridge. I think there's nothing that you can do to massage the numbers or make them better, because at the end of the day, the P&L is the P&L. You're only going to get so much for rent, and you're only going to be able to reduce the expenses so much. You just need to stay so on top of those things to make sure that you're paying attention to how the property is operating and holding the property management company accountable to meet your budget numbers, like your budget forma numbers. You have to hit these things, and it's crucial that you are really paying attention to asset management right now. I think that's the only thing that you can do.
yeah, so Prasad, I think what I would say, just to kind of tack on to what Tim's saying here, what I would say is like go to your underwriting and look at the things that are outside of your control, and don't make aggressive assumptions on those things. Like for example, when we do a bridge product, there's typically a refi event that happens at year 2 or year 3, or maybe sometimes even year 5, whatever. When we're underwriting to that refi event, I'm not assuming that I can get really good lending. I'm going to go in there and I'm going to assume, first of all, like Tim's talking about, I'm going to assume maybe best case I'm getting 70% loan to value. I'm certainly not assuming 80%. And then the other thing, right now I'm kind of okay underwriting to, I don't want to say go too aggressive on you here. I'm kind of okay underwriting to like a 6% interest rate. If I'm looking 24 months out, something like that, during my refi.
And I also want to comment. I want to challenge you on something here, and you could potentially get 80%. It just depends on the DSCR. Is there enough fat in the deal in order to support the debt service at 80% leverage? That's
Yeah.
what it'll come up to.
Yeah, to some extent, but even today, and I do tend to agree with you most of the time, but even today, in certain markets, especially tertiary markets, even with a high DSCR, lenders' risks profiles are
Yeah.
more.
Obviously, the market comes into play too. But I mean, if
Yeah,
we're talking, primary or secondary markets, you could technically still get an 80% leverage product. It's just, is there enough cash flow there to cover the debt service at that leverage?
yeah, yeah. I just again, Prasad, the bottom line is basically just those things that are outside of your control, to like cap rates, like interest rates, like what you're going to be able to get, your loan to value, things like that. Don't get aggressive on them. That's what I would say. If you're going with a bridge, be conservative on the things that you can't control. Like if you know that you can raise rents $300, by all means go after the $300 rent raise.
Yeah.
But just be very, very careful.
Yeah, absolutely. They're going to want some cushion there for sure. But I'm just trying to play devil's advocate there. I mean, there's obviously other scenarios that go into it, but it just depends. All right, it depends on every property. So there's a lot of moving
Yeah,
parts. There's a lot of different levers. I'm just trying to vocalize different levers to look at, to focus on, to think about. I mean, this is what goes on in my brain as I'm doing the underwriting for us. Is what is the market? What is the debt service coverage ratio? What are the different loan products that are available to us? What is the rate going to be in 24 to 36 months? Underwriting is one of I mean, obviously, because I do most of the underwriting, the most crucial part of the deal, because you make all your money on spreadsheets, right? You buy right, and then you maintain and operate right. So definitely pay attention to that stuff.
yeah.
And then thanks, Ed. Appreciate it. Finally got Tim Vest out of his job in April. And I'm coming up, 3 more months, and I've been out of my job for a year in 3 months. Can't believe it. Time flies when you're having fun. All right, guys. That's all we got for today. I love this. Like, this was a really great, engaging conversation. I hope everyone got a lot of value out of it. Tim, thanks for everything that you do with the banks, because you have way more patience than me when it comes to them. So, everyone, you need to find yourself a Tim, but don't take mine.
Yeah, I think Tim's confusing patience with me, like throwing things against the wall. But
That's what all the signs are covering behind you. Oh, okay.
yeah, it's holes in the walls, folks.
All right, guys. See you next time.
All right, take care, guys.